think you put us through on the calculation of the overhead absorption rates. Overhead absorption rate. You actually explained. You explained on how do you say it? How will you say? You said okay. Let me just put the way you say it, the example, because that's what is ringing in my head. You said you use electricity for an example, like the way two different people might be using electricity is different. The kind of appliances that I might be using, it will be different from the kind of appliances you might be using at your own place. So when we want to, since we are sharing meter or something, but when it's time to pay for the bill, it's like it's not possible for us to pay the same amount of money. So there will be like an apportionment for what you've used and an apportionment for what I've used.
Okay, that's fine.
Yes. So you said calculation of overhead absorption rates. You said we have to first identify the budgeted overhead for the period. Then we identify the budgeted activity level for the period also.
Okay, that's fine. Ima, thank you, Emmy, right? Emmy, thank you so much for that. Please, can someone still assist us on what we discussed in our previous lecture? Do you have anyone that want to give us small overview of what we discussed in our previous lecture? Do we have? Hello? Just one person, right? Are you the only one in that class? Emmy. Yeah, you're not the only one in that class now. So we still have some other professional colleagues that are actually in the same class, right? Okay, I think I have to call him, right? Uh Sylvia. Sylvia.
Yes, sir.
So please give us an overview of what we discussed under absorption costing.
Okay, what we discussed last week, that was not paying full attention, but you talked about the assumption costing, also known as full costing, compared to marginal costing that deals with just the variable cost. So for assumption costing, we talked about how we're going to use both the variable cost and the fixed cost together, since we are apportioning costs based on full costing method. And he said it's also known as traditional costing method or conventional cost. So let I talk about the OAR, which is the overhead apportion rate, how it is being calculated. And he said it's calculated as budgeted overhead over the budgeted activity level. And went ahead to talk about the format compared to the marginal costing approach, where we don't consider, like when we're apportioning for the opening inventory, we just use the variable cost. But for assumption cost, we are going to use the full costing method and talk about the over and under assumption, that when there's an over absorption cost, we had to the profits. I don't know if I'm correct. I was not paying for attention. Sorry. We had to the profit, and when there's like an under absorption, we remove profit.
Thank you so much. And it is what it is. And I think both of you have actually given us an overview of what we discussed, right? What was discussed in our previous lecture, right? Thank you so much, Sylvia and Emmy, right? So in today's class, we shall be looking at just we shall solve a question on absorption costing Then we'll do the reconciliation. The reconciliation of the marginal and absorption costing. If you can recall, I equally mentioned in our previous lecture that the reason why the profit of absorption costing is not usually the profit of absorption costing is not usually the same thing with marginal costing is because the difference in the valuation of inventory, we should not equally forget that the marginal costing value its inventory using variable cost, while the absorption costing value its inventory, right, using the full cost. It charges the full cost into the particular production unit, right? And I said that the marginal costing is used for short-term decision, and the decision is based on contribution, while absorption costing is for long-term decision. The decision is not based on the contribution, but rather the profit that was being made. And absorption costing is like your normal profit or loss account, right? Because you can actually present it for tax purposes. Why marginal costing, you can't present it for tax purpose because that marginal costing, it is contribution. You know, the relevant tax authority don't recognize contribution, right? So it is what it is, right? It is what it is. So please, like I usually say, that grace does not work in an isolation. You have to do what? You have to work for the grace, right? You can't just sit down and say you want to pass ICANN exam or ACC or any exam you want to pass, and you're not working towards it. You are not putting effort. You're not following the classes. You're not doing assignments. You're not going back to the videos, listening to it. You know, it doesn't work like that, right? It doesn't work like that. So please and please make sure you go back to the video, watch it because the beginning of success in performance management starts from that cost estimation to marginal costing to activity based costing. Right now, class. So who will read? Please, can someone read for us? Okay. I think we've done the marginal costing for this question, right? So we just need to pick the absorption costing. Now, Next Gen Professional Associates is into production of sugar. The selling price, can you see that the selling price is estimated at 45 naira per unit, class. Why the direct material cost is what cost per unit is what 11 naira per unit. Direct labor cost, the labor cost per unit is what 8 naira. Then variable production overhead cost is what is 4 naira per unit. We have fixed production overhead cost, right? 3 naira per unit. Then the variable selling 5 naira per unit. The fixed selling overhead is 2 naira per unit. The fixed administrative. Now, class, pay attention. The fixed overhead cost is incurred on a normal annual activity level of 96,000 units. Class, the fixed overhead cost, they are telling you that on their policy now is that the fixed overhead cost will now be based on the annual budgeted of 96,000 units. That is the budgeted level of activities of 96,000. So their budgeted fixed cost will now be based on, they will apportion their overhead on the basis of the budgeted unit produced of 96,000 units. You are tracing that fixed overhead cost to the budgeted unit of 96,000 units. You can see that it is stated clearly that it is based on 96,000 units. Now, and is expected to be incurred at a constant rate throughout. So we have all this before when we treat what is it called? The marginal costing. Now, from our format, let's quickly bring in our formats of absorption costing. Please, you should not forget the name of the company. It's very, very important. Presentation, right? So this is marginal. Okay. So let's quickly do the absorption costing here. Right. I have to think I have to cancel something. Okay. Okay. Juliet, mute your mic. So, what is the name of the company? Next Gen Professional Associates. Next Gen Professional Associates. That is the name. So, what is the requirement of this question? Don't forget the requirement is very important. Prepare profit statement. You can say determination of profit statement using absorption costing. So, determination of profits statements using absorption costing, right? Using absorption costing for January and February, right? January and February. Abidemi, are you in this class? I guess no.
Yeah.
Okay. Okay. You give us figures. Right? So we don't okay. So what is the selling price for January? What is the selling price? What is the selling price given to us from the question?
45 naira.
Selling price is 45 naira per unit. What is the sales unit?
7,000 units.
7,000 units. So what do we have?
315,000 euro.
315,000. Abidemi, where is your second? What is her name? I've forgotten her name. What is her name, self? Please, can someone remind me her name? I think. Okay. Who?
Abigail.
Is it Abigail? Okay. Okay. Okay, Abigail.
I think Esther. I can call her Esther or something.
Okay, Esther. Okay, that's fine. Excuse me. So we have here the cost of sales. The cost of sales, right? The opening inventory, right? So we're told from the question that there is no opening inventory as at January. Is that not so? As at January, there is no opening inventory for the 1st of January. Class, what is our steps? Our next step is to determine, we don't need to determine, what is it called? We don't need to determine opening and closing inventory. We've done that under the marginal costing. So I can just copy this. So since we don't have different, what is it called? We don't have different information. The information is still the same. The opening is not given. Then the production, we have 8,500 units. Then the sales unit is this class. So since we don't have anything under the opening inventory for January, right? Can put 0. Now, from our format, what is the next? What do we have? What's next after opening inventory from our format? Class. What next?
Production cost.
Production cost. Thank you. production cost. So that will be work 2, step 2, right? Step 2. So in determining our production cost is the full cost. We have to use the full cost per unit. Full cost per unit. So we start from the variable costs. What are the variable costs from the question? Variable cost. We have the direct material, right? Can someone list the variable cost that we have in this question? Quickly. Quickly.
Direct material.
Direct material.
Okay. So you just give me figure, right? Let's say we have direct material. Right, what do we have? What is the figure? Direct material?
11 naira per unit.
11 naira per unit. So next?
Direct labor.
Direct labor, okay.
8 naira per unit.
8 naira per unit. What do we have again?
You have variable production overhead.
Variable production overhead. So what do we have?
4 naira per unit.
4 naira per unit, right? Do we have any other variable costs?
Variable selling overhead.
So will you add variable selling overhead as part of your full cost? Even under the marginal costing technique, did we add variable selling? Who says we should add variable selling? Who is that? Emmanuel, were you in our last class? Did you start marginal costing with us? I guess no.
Are you
I was
trying
the
to?
one. No, I was the one. I was the one, sir. No, I was not in the last class. I'm sorry.
Okay. Even the marginal costing. Were you in class when we treat marginal costing?
Yes, I was not in the marginal costing class. That's the problem.
Okay, that's right. You have to go back to that video so that you understand why variable selling is not part of the variable cost that you will charge to production, right? Variable selling is for sales, right? It's for sales. Now, the next thing we need to add is our fixed cost per unit. Fixed cost per unit, right? Fixed cost per unit, which is our OAR, class. Is that also from the format? Fixed cost per unit, right? Right?
Yes.
Okay. Now we need to determine our fixed cost per unit, which is OAR. What is OAR, class? OAR is what?
Over absorption rate.
Assumption rate.
OAR is what? What is the full meaning of OAR?
Overhead absorption rate.
Overhead absorption rate. Should I write it in full? Overhead absorption rate or fixed cost. Let me use this. Fixed cost per unit. When you see slash, it is per unit. Or overhead absorption rate. If you check your material is there, right? Overhead absorption rate. Now, we need to determine this overhead absorption rate so that we'll get our full cost per unit, right? So that will be step what? Step 3, when you have determination of overhead absorption rate, which is OAR. Another name for OAR is what, class? Another name for OAR is what?
Fixed cost.
Is what? If you don't want to call it OAR or fixed cost per unit.
Cost.
Yes, it's not fixed cost, it is fixed cost per unit. If you don't want to call it fixed cost per unit, you say overhead absorption rate. Is that not so? Now, what is another name for overhead absorption rate?
Full cost.
Predetermined rates.
Thank you. Predetermined rate. Predetermined overhead rate. Predetermined rate. When you see a predetermined or overhead predetermined rates, is absorption, is OAR, right? Predetermined rate. If you check the material, it's actually there, right? Please. Now, determination of what? Overhead absorption rate, which is OAR. OAR, or fixed cost per unit, class. Fixed cost per unit, right? Fixed cost per one. So equals to budgeted overhead, right? Budgeted overhead divided by the budgeted level of activity. Don't forget, I said in our previous lecture that how the company will absorb their overhead. Absorption means consumption. How the company will absorb their overhead, it is based on the company policy. You can see that in this question now, right? If you check this question for the fixed overhead, where is the fixed overhead? Where is the fixed overhead? Where is it? Okay, now you can see that the fixed overhead cost is incurred on a normal annual level of what? On a normal annual levels of what? Activity. Now, class, you know, we're supposed to say budgeted overhead over the budgeted levels of activities of 96,000. Now, because the fixed production overhead cost per unit is given already, can you see it as what? 3 naira. So we don't need to. It is when you have the full cost of fixed overhead cost and fixed overhead cost, then you can now divide by the levels of activity so that you will have your overhead absorption rate. But in this question, the fixed production overhead cost per unit is given to be 3 naira per unit. Class, are we still together, please? Class, are we still together, please? So which means that you don't need to calculate your overhead absorption rate because it is given to be in the question as what? 3 naira per unit. Can you see it? Fixed production overhead cost per unit is 3 naira per unit. So you don't need to calculate your budgeted overhead over budgeted levels of what? Activity. Class, am I communicating, please? But in a situation whereby it is not given, you have to, maybe you may be given the fixed cost. They're given the budgeted fixed cost, then you divide it based on the company levels of absorption, right? Now, in this question, it is based on the unit produced, that the budgeted unit of 96,000 units, right? So the fixed production overhead cost per unit is given to us in this question. So you don't need to calculate it again. Class, are we still together, please?
Yeah, we're together.
Yes, sir.
Okay, that's fine. So we now move on. So the fixed production overhead cost per unit, right? So it's given to be 3 naira, right? 3 naira. So we don't need to calculate the OAR. So it is given to be 3 naira. It is given in the question 3 naira, right? 3 naira per unit. So what is the total fee full cost?
26 naira per
Is the full
unit.
cost per unit?
26
20
naira per unit. 6 naira
Thank
per
you.
unit.
26 naira per unit. 26 naira per unit. This is the full cost. So you now value your inventory, both opening and closing inventory, using the full cost per unit, full cost. Class, please don't add variable selling as part of your variable cost to class. Variable selling is for sales. Did you use variable selling in production? No, you use it when you want to sell. Class, when you want to sell, right? Now, if we have this to be 26 class, so the production cost Class. So the production cost means what are the total costs that you incurred in the production? Your variable cost plus your full cost, because your variable cost plus your OAR, or fixed cost per unit, or predetermined rate, right? From the format, right? So we can have 26 naira per unit times, what is the unit produced, class? Which will give us the cost.
8,500 units.
8,500 units, right? We give us the cost that it will take next gen to produce the 85,000 units, class. Now, what do we have? If you multiply
221,000 naira.
221. So this sales supposed to be here, right? 200 and what?
21,000 naira.
221,000 naira, right? Now, from our format, what do we have after the opening inventory? Add your purchase cost, maybe your production cost that will take you to produce that particular unit. Then what do we have after that? What do we have? We have closing
inventory.
Thank you. The closing inventory. So we'll value the closing inventory using the full costs. The full cost is 26, full cost per unit, which is 26 naira per unit times what is the closing inventory. We've done that in our previous lecture to determine the opening and closing inventory. Thank you. 1,500 units. Can you see it? 1,500 units as the closing inventory. So 1,500 units, value the inventory using the full cost under the absorption costing. So what do we have?
39,000 naira.
39,000 naira, right? So what is our gross profit? Okay, no. So remove it. 22,221.
182,000 naira.
182,000 is our cost of sales. So if you remove it from 315, we have the gross profit.
133,000.
Right? 133. Oh, we're done. Okay. $133,000. Class, are we still together? Class, are we still together?
Yes, sir. Yes, sir.
Like, who is against me
Yes,
in this
sir.
class? Hello, I need to know. Michael, you're always against me. Michael, why? Michael, you're always against me. Why? Okay, that's fine. That's fine. So, class, so we need to move, right? Let's check for the February. So what is the selling price for February? Is still 45 naira. What is the sales unit for February? What is the sales unit for February?
8,750 units.
8,750. 8,000. Please, you can do your workings outside, right? You can do your workings outside so that your reference is okay. Work 1, work 2. 8,007 what?
750 units.
750 units. Right. 750 units. So what is the sales? What do we have?
393,750.
750. Right, 750. Class, we still move to this side of production costs. Now, before we move to the production cost, definitely the closing inventory. Look at the value. The closing inventory of January will be opening inventory of February. So you lift it like that. So this to be 39,000 naira. Right? So your closing, your production cost, right? What is the unit produced for February class?
7,750 units.
7,750 units. Class, in a situation, 7,750. Is that not so? So don't forget that I've equally mentioned that you may have different, what is it called? Direct material. Probably you are given for year 1, year 2. The direct material for year 1 may be different from year 2. So you have to analyze it, right? And kudos to those who actually attempt that question 3. You guys are doing well, right? Makes sense. And I actually like the arguments in that group on budgeted and actual, right? So it is very important for you to understand. I think someone actually give us an analogy on fixed, the actual and budgeted. It is not possible for you to say you want to budget for 20,000 naira electricity. Okay, what is the actual? The actual, it is the actual that you will recognize in your in your accounts. Since it is profit or loss, it is the actual. What is the actual result? This is the actual what? Result, right? Now, if you multiply this, what do we have? The production cost
201,500.
201,500. So we can still move. What is the closing inventory for February? 500 units. Thank you. 500 units. 500 units times the full costs. 26 naira times 500 units. So what do we have here?
13,000 naira.
13,000 naira will be the closing, right? So what do we have? We had 39,201, then minus 13,000. What do you have?
227,500.
500. Okay, thank you. Right. Okay. Okay. So what is the gross profit?
166,250.
Okay. Makes sense. 166,250. Okay, that's fine. Okay, now you can see that we need to do what? We need to determine over and under absorption, right? So that when you have over absorption, you will add it to your income. When you have under absorption, you have to do what? You have to add it to your expenses, of which I've actually explained in our previous lecture, that you cannot compare Abidemi and Abigail. Before you can compare Abidemi and Abigail, they must have something in common, meaning that the budgeted overhead, right? The budgeted must have element of what? Element of actual, right? Budgeted must have what? Element of what? Element of actual. Now, let's quickly go back to the question. All right, this is how to determine our over and determination of over slash under absorption. So we need to determine if it is over absorption or under absorption. Class, which is calculated as the actual fixed. You appreciate this more, right? When we get to variance analysis, right? This actual fixed overhead, right? So actual fixed overhead, then your overhead absorbed. Your overhead absorbed is what? Is your budgeted, right? So don't forget that it is calculated as OAR times the actual, so that the budgeted will have element of actual production. So you can now compare, right? You cannot compare. You cannot compare Michael and Emmy. They must have something in common. Now, class, let's quickly go back to the question. We are looking for actual fixed overhead costs. Actual fixed overhead. Now, class, if you look at this in this question, are we given anything that has to do with actual fixed overhead costs? Class, look at it very well. Is there any actual fixed overhead cost? Class, is there any actual fixed overhead cost? Response, please. Hello?
Yeah.
Yes.
Yes.
Where did you see actual fixed overhead? Yeah, where is it?
Fixed overhead cost is incurred on a normal annual activity level of 96,000 units.
Unit. That is units. I'm talking about what is the actual fixed overhead costs. Like they give you actual fixed overhead costs in the question. Now, what we're given is just that the fixed overhead cost will be incurred on the annual levels of activity. That is the basis of absorption. They are telling you that they will absorb their overhead on the basis of the annual level of activities of 96,000 units. But say what? Do you get that?
Yes,
But
sir.
say what? Do you get it? So now, so the actual fixed overhead cost is not given to us in this question. Now, you don't need to do work back. Don't stress yourself, right? When the desirable is not available, the available becomes the desirable. Now, we will now change the approach, class. We will change the approach. Now, in this case now, since you don't have something that you will use to compare, it's not given to you, don't stress yourself to do work back or anything. So let's change it. Let's change it. Or let's quickly change the approach, right? Or now you have January and February. Class, what is the actual production units? Actual production units What is the actual production units for January?
8,500.
January is 8,500 units.
Units 8,500, right?
Yes.
Units 8,500 units. How many units is this?
7,750 units.
7,750 units. What is the budgeted? What is the budgeted unit given to us in the question? Budgeted unit.
96,000 units.
6,000.
8,000.
You said?
8,000 units. 8,000 units.
Thank you, Margaret. Thank you. Thank you. The 96,000 units is annual. Please always pay attention to. You can see the 96,000 units is what is annual units, annual budgeted units. And you want to calculate for just February, January, and February. Annual. Thank you, Margaret. Please. Now, so we will have what? 8,000. You divide it by 12 so that you will have what? For each of the what? Months. So 96,000 units divided by 12. So let me quickly show the workings. So we have what? 8,000 units. Can you see that we change the approach now? That is why I said when the desirable is not available, the available becomes the desirable. You have to think, right? We'll get to we'll still the under variance analysis, work back variance. Right? We'll get there. Now, the actual production unit now and the budgeted. This is where you can now compare if it is over or it is what? Under. Now, it is a very simple question, no? Right? It's a very what? Simple question here. Margaret, are you still with us?
Yes, I'm here.
Okay, that's fine. Now, the actual production is 8,500. The actual production. Now, we are not comparing costs now. We now move to units that, oh, since actual fixed overhead is not given, how do we determine? Don't stress yourself to want to do work by. You want to get actual fixed. Now, change the approach to unit produced and budgeted. Now, you said the actual production unit, you produce 8,500 units. And you budgeted for 8,500 units. Is it over or under absorption? Is it over or under, class?
Over.
Is
Over for January.
Thank you.
And
It is
under
for January.
February.
Thank you. It is over for January because when the additional units that you produce will be a gain, we become a gain to the company. We become a gain to the company. It means that the company gain more on that production because as they produce like that, right? As they produce, their sales will also increase because they produce more than what they. So it is gain. That is over absorption, right? So what is the difference? 500
units.
Thank you. 500 units over / under, right? So what is the difference? This is
250 units.
250 in brackets, right? Because we've already budgeted that produce 8,000. We've already budgeted for the cost as well. Produce 8,000. Then you now produce 7,750. Now the question is, who will pay for the cost? Who will pay for it? It is a cost. Who will pay for it? You did not produce. So who will pay for what? It is fixed. It is unavoidable. You've already said this is what you want to incur. And if you produce this, you don't know so that you will meet up with with the profit. Then the question is, who will pay for the cost? It is loss.
That's not so expensive.
Thank you. Thank you. It becomes what? Expenses. Right? So now you now multiply by the OAR. So multiply by the OAR so that you get the costs. Right? Multiply by your OAR or fixed costs per unit. Per unit. So which is 3 naira per unit. Which is 3 naira per unit. So what is the cost? What is the cost when you multiply?
1,500 for January.
Okay, for January, 1,500.
And 750
For the over / under. So this is 750. Class, am I communicating?
Yes, sir.
Thank you. Now, if this is established, we already determine the over, but in a situation whereby the actual fixed overhead is given to you, please use it. Use the actual fixed overhead, then your overhead absorbed, which is your budgeted. The budgeted overhead must have element of actual. So that is why you will use your OAR, young Alaji. This now. Meet your mic. So that is why you multiply the OAR times the actual production. Then you will now compare. This is just like your budgeted, and this is like your actual. So is it over or under? Right? You can see. Now, the over will be added. So the gross profits as income will be added over absorption. What is the over absorption? 1,500. This is 0. So what is the total income? The total income, class.
134,500.
Total income. 100 and what?
34,500.
500. So this 166,250. Right? So our expenses What are the expenses that you may likely incur? Maybe variable selling, fixed selling. Class, variable selling, fixed selling. Expenses, let me check from the format. Expenses. Class, any other expenses that you incur, maybe variable selling expenses, selling, or fixed selling expenses. Please don't include your fixed overhead again. No. Do you know why? Because you have used the fixed overhead to determine over and under absorption. So if you are bringing in the fixed overhead, that is what you have. That is double counting. Is that not so? Right? Right? You will understate your profits. Class, am I communicating? You don't need to bring fixed overhead again because you have used the fixed overhead to determine over absorption and under absorption. Class, am I communicating, please?
Yes, sir. Please come again, sir.
I said you don't need to bring in fixed overhead again. Your fixed overhead cost, you don't need to bring, whether it is actual or budgeted, you don't need to bring in the fixed overhead costs. Why? Fixed overhead costs. Because you've already used it. You've used it now. You don't need to bring your budgeted, sorry, you don't need to bring in your budgeted fixed overhead cost. Budgeted fixed overhead cost. You don't need to bring in your budgeted fixed overhead cost because you've used it to determine your over and under absorption. So how do we determine our over? Is it not budgeted overhead divided by the budgeted levels of activity? You've used it. So you don't need to bring your budgeted fixed overhead again, right? You can bring your actual fixed overhead if you have actual what? Fixed overhead. What I'm saying is we have, for the purpose of this question, in this question we have variable selling. Is that not so? Variable selling overhead. So what is the unit? What is our variable selling overhead? What is the variable selling overhead?
5 naira per unit.
What do we have?
5 naira per unit.
5 naira per unit. So what is the sales times the sales units? What do we have?
7,000.
7,000 units. What do we have?
35,000 naira.
35,000 naira. So we still have the same 5. What is the sales unit? Because it is variable selling. What do we have?
8,750 units.
8,750.
$43,750 naira.
43,750. Class. Now, I'm coming on, Margaret. We have under absorption. Under absorption. What is your under absorption? 250, right?
750.
Is it 750 or 250?
750.
Okay, 750. 750. Right? Now, which other overhead do we have from the question? We have variable selling, we have fixed selling, and the fixed administrative overhead. These are overhead costs. Fixed selling overhead, fixed administrative overhead. They are not budgeted overhead. They are not budgeted fixed overhead. Class, the fixed selling overhead and the fixed administrative overhead, they are not budgeted fixed overhead. Class, so you don't need to bring in, who is that now? The person, mute your mic. Abidemi, mute your mic. So you don't need to bring in budgeted fixed overhead as part of your expenses because you've used it to determine your over and under absorption. What you need in your expenses is your actual fixed overhead expenses, your variable selling, your fixed selling overhead, your fixed administrative overhead, your actual any other actual fixed overhead. You don't need to bring in fixed production overhead though, because fixed production overhead is a budgeted overhead and you've used it to determine your over and under absorption. Class, am I communicating, please?
Yes, sir.
Margaret, did you get that?
Yes, yes.
Okay. So which other costs do we have? We have fixed selling overhead, right? Fixed selling is per unit. You can see in this question, they didn't give you the value, they just say per unit. Some question they will give you the variable selling overhead cost, the cost. They will not give you the per unit, right? Fixed what? Fixed selling, right? Fixed selling overhead. So what is the cost per unit? What is the cost per unit? 2
Naira
per unit times class times 2 naira per unit times what?
7,000.
7,000.
7 times what? Talk now.
7,000 units.
Times 7,000 units. Okay. Fixed what? Fixed selling. So times 7,000 units. What do you have?
14,000.
What do we have?
14,000.
14,000 units.
14,000 units. Now, my question to you is that, is it Prince? Thank you.
14,000.
Thank you.
Hello,
Prince.
sir. Good evening.
Yeah, good evening. Go ahead.
Yeah, sir, please, I don't think we need to use that 7,000. No. It should be 8,000
Okay.
units.
Okay, thank you.
Yeah.
Okay, thank you.
All right.
I know. Yeah, thank you. So, can you see? So, let's quickly go back to the question. Right? Fixed selling overhead. Class. Now, class, let's quickly go back to cost estimation. Fixed. The first one is variable selling overhead. Variable selling, variable cost will varies according to the sales units. The next thing is fixed selling. Fixed selling will not varies with the numbers of units sold. It is fixed selling. Fixed selling. It will not varies with the numbers of units sold. No, because it is fixed selling. The first one, why we use 7,000? It is because it is variable. It varies. Variable selling. If it is fixed selling, we will not use 7,000. We will use what? We will use 8,000 units because it is what? We will not use any of the sales units and production units if it is fixed. Now, because it is variable selling, it varies with the units sold. Now, fixed selling overhead does not vary according to the production or sales. It is based on budgeted. Fixed administrative overhead does not vary according. No, fixed administrative it does not change according to your sales or your production. It is fixed. It is based on budgeted. It is only when you have variable selling, that is why you now know, oh, variable selling, this will vary based on the sales unit. Class, am I communicating?
Yes, sir.
Now, okay, thank you, Prince. So 96,000 divided by 12. So what do we have? That is 8,000 units times figure.
16,000. Well,
16,000 naira, because it does not vary. You can see the first variable selling varies. That is why you have different figures. Because it is fixed, you still have the same thing. But in some questions, just like the assignment I gave, right? You may who is that? Margaret, please mute your mic. You may have fixed selling overhead, maybe for year one, maybe 2 naira, maybe for year 2, 3 naira. But their budgeted does not change. Budgeted is budgeted. Budgeted is what you budgeted for, right? Now, this is 16,000. Which other fixed do we have? We have fixed what? Administrative, right? Class. Fixed administrative.
yes.
So what is the cost per unit? What is the cost per unit?
3 naira per unit.
3 naira per unit times 96 units divided by 12. What do we have?
24,000 naira.
24,000
naira.
24,000 naira is fixed. 24,000 naira. So what is the profit? What is the profit? Profit or loss? Is there profit or loss?
59,500 for general.
Profit. $59,500. Profit. Profit is what? What do you have here?
81,750 profit.
81,750.
750.
Okay. So this is the profit. So we need to reconcile the two profits, because the reason why you will not have the same figure in the profit statement is because the difference in valuation of inventory. The differences in the valuation of inventory, right? That is the reason why you will see the profit of marginal costing and the profit of absorption costing will not be equal, right? Let's assume that in a question where you have reconciliation, so you need to confirm if your answer is actually correct by reconciling the profit of absorption costing with marginal costing. Meaning that if you start with profit as per marginal costing, you should end it with what? Profit as per absorption costing. Class. So if you start with profit As per absorption costing, you should be able to arrive at what? The profit as per what? As per what? Marginal costing. So whichever one we want to start with. Now, reconciliation. 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 Right? Reconciliation. So which one are we starting with? Just like our normal bank reconciliation statement. Either you start with profit as per cash book or as per bank statement. So which one are we starting with? So should we start with profit as per marginal costing so that we will arrive at profit as per absorption costing? Or we start with profit as per absorption costing, we will arrive at profit as per marginal costing. Class?
Profit as per marginal costing.
Okay, profits as per marginal costing. So we have for February, or we need to do for February. For February, right? And February, January and February, right? Okay, January. So what is the profits for January? What is the profit as per marginal costing?
55,000.
50 what?
55,000.
Okay, 55,000 naira. Let's check the profit for February. What do we have? What is the profit of February, class?
84,750.
84,750. Now, because of the differences in the valuation of inventory, so that is what we will use to determine to do our reconciliation. So therefore, class, you can write it somewhere. If profits, if the opening, you are starting with marginal costing. Okay, this is marginal costing. We are starting with profit as per marginal costing because we want to arrive at profit as per absorption costing. Class, if the opening inventory of marginal costing, why do you start with marginal costing? The reason why I start with marginal costing is because we started with profit as per marginal costing. If you are starting with profit as per absorption costing, you need to say, okay, if the opening inventory of absorption costing. Now, if the opening inventory of marginal costing, which is MC, or let me use MC, is greater than absorption costing, AB, right? Add the difference. Class, if for instance, the opening inventory of marginal costing, I said what? Add the difference. Add the difference back to the profit. Now, add the what? The difference. If the marginal costing, for instance, is 60 and it is higher than the absorption costing of 30. What is the difference? Add the difference. You add the difference. The difference is what? 30 naira. Now, in another case scenario, where if the opening inventory of marginal costing is less than absorption costing, which is AB, subtract the difference. Subtract. Now, what it means is that if the marginal costing, right, opening inventory is 60 and the absorption costing, right, and the absorption costing, this is for marginal costing, opening, and this is for absorption costing. Let's say absorption costing is 70, right? So what is the difference? You can see that it is lesser. The difference is what? 10. Is that not so? The difference is what? 10. So you have to subtract it. You have to subtract the difference from the what? From the profits. You can see the first one you have to add if it is greater. The second one you have to what? Subtract the what? The difference. Now, this is for opening. The reason why I use if opening inventory of marginal costing, why I started with marginal costing, it is because we started with profit as per marginal costing. You can start with absorption costing by restating this. Now, for the closing, I can just copy this. It is opposite. For the closing is opposite of this, right? So if the closing inventory of marginal costing is greater, is greater, class. If the closing inventory of marginal costing is greater, you know, the first one we had the difference. So here you will do what? You will subtract the difference. So the same thing applicable here. If the closing inventory of marginal costing is lesser, you know, you subtract here, right? It's less than absorption costing. You subtract there, you had the difference. Class, am I communicating, please? Am I communicating, please?
Yes, sir.
Okay, this is how you will do your reconciliation. Why do you have to do it this way? It is because the reason why you have difference in the profit, it is because the difference is in the what? In the valuation of the inventory, right? Because of the difference in the valuation of the inventory. Now, let's start. So, opening inventory. Now, class, if the opening inventory of marginal costing is greater than absorption costing, we are going to add the difference. Now, let's check for January. We did not have, I guess we did not have opening inventory for both marginal costing and our absorption costing, right?
Yes, for January.
Okay, for January. So we don't have anything there. All right. Where is it now? Where is it? Oh, away. Okay. So we don't have anything here. we can have 0. Now, class, in this part of February, we have what is the opening inventory of marginal costing? What is the opening inventory of marginal costing?
4,500.
Can you see? The opening inventory is 34,500. It's 34,500. It's 34,500. 34,500 for marginal costing. 34,500. So for the absorption costing, what is the closing inventory of absorption costing? What is the closing inventory, class? 39,000. Can you see it? 39,000. 39,000. You can see that the opening inventory of marginal costing is less than the absorption costing. You can see that that is the reason why you have 34,500 first, and you have 39,000 naira for the absorption costing. Can you see that? What is the difference? What is the difference?
4,500.
4,500. Can you see it? 4,500. The marginal costing is lesser, right? That is why you see 34. You can see, ideally, if you look at it in another perspective, 34,500 minus 39,000, that is minus 4,500. Because we are starting with the profit as per marginal costing. Now, for the closing inventory, so what is the closing inventory for marginal costing? What is the closing inventory? What is it for marginal costing? What is the closing inventory? Marginal costing? Class?
34,500.
34,000. That would be the opening. That would be the opening for the other part, right? So it is 34,500 minus what is the closing of absorption costing? What is the closing of absorption costing? What is the closing inventory of absorption costing?
13,000.
39.
Oh, 39.
Okay. Okay. Is it okay? Okay. We are still in. Okay. Yes. Closing. It's 39 now. Is that not so?
Yes, 39. Sorry.
39,000. 39,000. 39,000. So what is our principle? Is that right? Is
Yes,
that if the closing, thank you. If the closing inventory is greater of marginal costing, if it is greater, you can see that the closing inventory of marginal costing is 34, while the absorption is 39. If it is greater, which one is greater? It is not greater now. Is that not so? Now, the question is, which one is greater? The absorption costing. You have to add it. If the closing inventory of marginal costing is less than absorption costing, right? If you look at it now, the marginal costing is 34,500. The absorption costing is 39,000. It is not greater. It is less than. Right? It is less than. So we had the difference. Class, you do what? You do what? You had the difference. Can you see it? You do what? You had the difference. So what is the difference? The difference is what?
4,500.
So you still come here and check. What is the closing inventory of marginal costing? You quickly check. What is the closing inventory of marginal costing? 11,500, right?
Yes, 11,500.
500. 11,500. 11,500 minus, what is the closing inventory? What is the closing inventory of absorption costing? The closing inventory of absorption costing
13,000.
is 13,000. Then we'll go back to our principle, right? 13,000, right? Is it 13,000? Okay, 13,000.
13,000.
13,000. Now we'll go back to our principle. Don't forget that this is marginal costing. This is absorption costing. And what is the principle? Principle says that if the closing inventory of marginal costing is greater, right, than absorption costing, you subtract the difference. And when you look at it, this is for marginal costing and this is for absorption costing. It is not greater, right? Now, let's go back to the second principle. If the closing inventory of marginal costing is less than, can you see that the closing inventory of marginal costing of 11,500 is less than the absorption costing of 13,000? What do? We add
We
the
add the
difference.
difference.
So what is the difference?
1,500.
4,500.
1,000.
Okay, 1,500. So class, we must arrive at the profit as per absorption costing. So what is our profit as per absorption costing? Profit as per absorption costing. If your reconciliation did not balance, that means that what you did in the calculation is actually wrong. You have to go back and check what happened, right? Profit as per absorption costing. What do we have? What is the profit?
59,500.
59,500. Can you see that we arrive at the profit? What is the profit here?
It's 1,750.
It's 1,750. It's as simple as ABC. You can start this logic as you can start with absorption costing. The same thing you did here, you can start it. You can say if the opening inventory of absorption costing is greater, you had. If the opening inventory of absorption costing is lesser, you subtract. It's just the opening inventory and the closing inventory is just opposite, right? It's just opposite. You should be able to arrive at this answer. If you did not arrive at the profit as per absorption costing, it means that the valuation of the inventory is actually wrong. You have to go back. Something is wrong. It may not be only the valuation of the inventory, it may be from your calculation, right? You have to go back and check, right? Because this is what reconciliation. Distinguished professional colleagues, I think I've been able to do justice to the question. If you have questions, quickly unmute your mic before we go. Question, please. Hello, question. No question? Hello?
No question.
Also, no questions.
Okay, it is well understood, right? So I think we have to go. So thank you so much. For those who are just joining Friday, quickly, please. I need to go. I need to enter a meeting. Friday, quickly, please, quickly.
Good evening, sir. Can you hear me?
Yes, I can hear you now.
Please, for clarity, I want to understand in the reconciliation statement, the balances as per profit. The profit. Hello.
I'm with you.
You are not sharing the screen again. I wanted to ask question concerning the figure.
I'm sharing the screen now. Please confirm. Can you see my screen?
I can see it now.
Okay.
Yeah, it's waving now. I can't see it again. Okay. the profit as per assumption for January and for February in the reconciliation statement, are they supposed to be the same?
No, they can't be the same now. What do you arrive at in your calculation? In your calculation, what do you have here in your calculation? Are they the same? It may not be. It's actually there that you see the same January and February. No, it's not possible. But I can't say it's not possible though. But something should have been wrong if you're having the same figure for January, the same. That means it is the same figures they give you for the fix and everything now. So they are having the same profits for January and February.
Okay, sir. Thank you.
Yeah, you're welcome. So any other question, please? Any other question? Okay, Timothy, quickly, I need to join a meeting. Quickly, just quickly, please.
Sir, can you explain again about over and under absorption? Why
You
we
go back to what you will do is that go back to the recording of I think the part of absorption costing. Share is absorption costing. This is part what? The other one is part 1. This is part 2, right? Just go back to the absorption costing part 1. Okay, Timothy, I believe you understand the over and under absorption. Do you understand?
all right? Yes.
Thank you. Thank you. Prince, any other question? Prince, do you have a question for me? Okay. So okay. So our next topic is activity-based costing. We should not forget that the traditional approach, which is the absorption costing method, absorbed its overhead on the different bases, right? It absorbed its overhead on the different bases. The budgeted overhead over budgeted levels of activity, all right, which could be machine hour, unit produced, or others. Now, the reason for the existence of activity-based costing came into existence to replace the traditional absorption costing, traditional approach, which is absorption costing. Why? Let me quickly give us a brief history. Why absorption costing, the activity-based costing came into existence to replace absorption costing. Now, if you look at it, in the absorption costing, in the calculation of OAR, it accumulates cost, overhead absorption rates, just like what I think Sylvia, right? Just like what Sylvia explained. Is it Sylvia or the other guy, Emmy? It accumulates all the costs to determine the OAR. Now, the question now is, you are overcharging A, you are undercharging B. Now, absorption costing is overcharging someone who is not using that particular, maybe electric appliances or that particular stuff, things, right? Now, activity-based costing now say, no, let's apportion it this way. You will pay me, I will pay electricity bill based on consumption, based on what I consumed. I will pay electricity bill based on what? Based on what I consumed. It is not that you have 6 units of 3-bedroom flats. They bring a bill of 50,000. You now say, oh, divide it by 3 or divide it by 6. That is absorption costing. It is absorption costing. It is your overhead. That is the total cost is 60,000 divided by the numbers. Right? We give the cost per one. Right? That is absorption costing. That is traditional approach. Now, absorption costing now, activity-based costing now say, oh, that approach is very wrong. You may be overcharging Prince because Prince did not have anything that has to do with water heater or anything that has to do with electronic appliances. Prince did not have it. So why should please pay the same amount that someone that is using everything in his or her house, right? So that is why activity-based costing now say, oh, we have to apportion it based on consumption, based on what you consume. So if you are staying in a place whereby they will bring a water bill and they will tell you that everybody should pay equally, you can decide to say, no, that is absorption costing approach. That's a no, it should not be done that way. Everybody should. That is the reason why you see today, everybody have meter. Pay based on what you consumed. Plus, pay based on what you consume. That is activity-based costing. On this note, thank you so much, everyone, for joining, and enjoy the rest of your weekend. We'll continue from there in our next class. I'm very sure you will enjoy activity-based costing. From activity-based costing, the CVP ratio, multiple, single. From there, we need to move to the decision part, which are the decision, limiting factor, from limiting factor to throughput, from throughput to relevant costing. Right. Thank you so much, everyone, and enjoy and have a wonderful weekend. I say weekend. Have a wonderful week. Thank you. Thank you.
Thank you very much.
Yeah, thank you.
Thank you.
Yeah, thank you.
Thank you, sir.
Yeah, thank you.